Well, hello and welcome to Super Insider, Australian Retirement Trust podcast about everything to do with superannuation. You might realise there's a different host in the chair. I'm filling in for our regular host, Anne Fuchs. My name is Kane Everingham. I'm from the education team at Australian Retirement Trust. Now, in my day job, I guess you could say, I get to travel around the countryside delivering seminars and webinars to thousands of members across this beautiful country. And we often get a lot of questions about the age pension. How does it work? Am I even eligible? So because the age pension is quite a complex area, we've actually got an expert along today. So we've got Mr. Justin Bott, who is the Community Information Officer at Services Australia. Services Australia are the Australian government agency that runs Centrelink. That would be the name that you're probably more familiar with. So welcome, Justin.
Well, thank you so much for having me.
Now, look, before we go into any more information, though, do have to let you know that anything you hear from myself or Justin today is general advice or general information only. Please make sure you consider, is what you're hearing right for you? You've got access to financial advisors. They can give you your own plan to make sure if that's applicable for you. So please do that. Now, look, if you're new to our podcast and you want to join our community, you can join us and just subscribe via the platform that is your preferred option. Now, look, before we get into the questions, I'm going to put you on the hot seat, Justin, and ask you a lot of the questions around age pension. But before we do that, I'd like you to, if you could, introduce what do you actually do for Services Australia and what does Services Australia do for retired or older Australians?
For sure. So I'm the Community Information Officer from Services Australia, which means my role is to do really what we're doing right now, which is to take opportunities to get out into the general public and explain Services Australia's payments and services. So we're a big organisation. Services Australia looks after Centrelink, yes, but also Medicare and the Child Support Agency, amongst others.
Beautiful. Thank you, mate. Now, I'm going to strip it right back to bare basics.
Sure.
Effectively, I'd like us to start. What actually is the age pension and why do we even have the age pension?
So the age pension is the government's safety net to make sure that older Australians will always have a source of income. Depending on your ability to generate any wealth of your own. You may have significant wealth that you've been able to build up. You might not have been fortunate enough to be in that position. And so the age pension is that underlying safety net to make sure that, as I said, older Australians will always have some source of income. So to be able to get it, there are a few rules that you need to meet. First of all, you have to be old enough because it is an age pension. So it's what we call age pension age, and that's 67 years. You have to meet the residency requirements, which is 10 years as an Australian resident. 5 of those have to be continuously living in Australia. So 10 years in total with at least 5 years as a continuous period of time living in Australia. And then you also have to have your income and your assets under the limits, the cut-off points, in order for the pension to be payable. So you've got to be old enough, have to be an Australian resident, have to have income and assets under the limits in order for the payment to be made.
So let's go to those limits then. So, you've touched on who's eligible. So there's age requirements, etc. But if we go to apply for the age pension, what are the limits? What are the tests that apply?
Okay, so there's actually quite a long list of what this is. And I'm just going to say up front that the best thing to do is to go to our website, servicesaustralia.gov.au, and on the front there you're going to find some panels. One of them will be ageing. There's another one, health and disability. You can click on those and you'll actually find the limits because I'm not going to give them all. It's just too long a list to try and go through them about single homeowners and all that sort of stuff. But we will give the basics so people can understand. So the first thing we're looking at here is the income test, because when it comes to a pension, we're going to look at your eligibility under your income, or what's your assessable income. Then we look at your assessable assets. You have to be under both of those limits for a pension to be paid. Now, that doesn't include something that we will talk about later, I'm sure, called the work bonus, which actually allows you to earn more if some of that income is coming from wages. So in the majority of cases, we don't count the family home. When we're looking at income and assets, what we're talking about for income, for example, we're talking about wages, deemed interest from financial assets, maybe net rent from rental income or profits from businesses. So it's, what income is coming through, what am I earning? When we're looking at assets, we're talking about the things that you own. So it might be investment properties, holiday homes, your car, your caravan, household contents, personal effects, Also, financial assets like the shares, the managed investments, those sorts of things. Even if only one of you is applying for the pension and the other one isn't, because that's often something that we're asked. Well, I'm applying for a pension, my partner isn't. Does that mean I'm a single person or a couple? You're a couple. We're going to look at both of your assets when we're looking at that pension eligibility.
Yeah, beautiful. And that's something that we, often comes up. A lot of people are surprised at those upper limits too. So there's the lower threshold to essentially get the maximum entitlements, and then there's that upper threshold. And a lot of people that I meet are surprised at those income and assets upper thresholds of how much they can actually earn or have before they actually get zero pension entitlements.
Certainly under the income test, there's one of the mistakes or misthoughts, I guess, people often have is that I can't actually earn an income and get a pension at the same time. And that's actually exactly not how the pension works. The pension is actually designed to encourage you, certainly for older Australians, if you want to work, then the pension may well still be payable for you. Again, with the work bonus that we mentioned, you can actually earn quite a significant amount of income and still have some pension eligibility. Now, it won't be the full rate, but still be some pension payable. And for a lot of people, the next question is, if I don't get the full rate, do I get the same pension concession card? And the answer to that is yes. So even if you're only getting $40 a fortnight instead of $400 a fortnight, your concessional benefits are exactly the same. So people who aren't applying because they're working too much may actually be missing out on some pension payments and concessional benefits that they might otherwise be eligible for. But again, the other thing about it is it's not a static figure. Those cutoff points, they change quite regularly. And the dates that they change, we're talking about the 20th of March, the 1st of July, and the 20th of September. So on the 20th of March and the 20th of September, the pension itself is indexed based on CPI and some other factors, which is why I encourage anybody, if they're not presently getting a pension, to just have a look at our website around the 20th of March, 1st of July, 20th September, see what the new figures are, because they may well become eligible when they weren't eligible before.
It's a great call out. It's something I often talk to people that I meet out in the field around, once a no doesn't always mean always a no. So to your point, with limits changing, with their own personal circumstances changing, they start to spend through some of their retirement money. So that can absolutely change your situation. Now, just before we move off the limits, I just want to check, if I'm out there, I'm getting some pension one way or another. If those thresholds, if some of the rules change or anything like that, is there anything I have to do as the pension receiver?
Those automatic changes are exactly that. They're automatic. So
beautiful.
This is an automatic process, nothing that anybody needs to do. And if you've been on a pension for a while, it's something you're quite used to.
Beautiful. Now, I want to move on to, you did touch on this, but I'll pick on myself as an example. Married, I'm 4 years older than my wife. Let's say I get to my pension age and I apply for the age pension. How does that impact having a partner?
A couple is a couple is a couple. Okay. So people often come to us and say, well, our finances are separate or anything like that. That's not how Services Australia works. Traditionally, when we're looking at a member of a couple, we're going to look at your combined income and assets. So what your partner's earning is going to impact on your pension eligibility. What your partner owns is going to impact on your pension eligibility. The only big difference in that scenario that you gave was that if my partner's 4 years younger than me and I've just turned 67, my partner therefore isn't age pension age. The only real asset we're not going to look at then is your partner's super, if that super is sitting in accumulation, as in they're not doing anything with it, they haven't touched it, they haven't rolled it over into an income stream, they haven't pulled it out and put it into a bank account. While it sits in accumulation and while they're under age pension age, that will not count towards their eligibility for anything, and it won't count to your eligibility for anything. But apart from that, anything that they own, any income that they earn will be counted towards your pension eligibility.
Wonderful. Thank you, mate. That's a common scenario that comes up. Now, I promise you I didn't tee you up with this one, but you mentioned there super being assessable, not assessable. So obviously our listeners, we tend to focus on superannuation topics, so very important. How does my superannuation actually impact my age pension entitlements?
Yeah, so for people who are under age pension age, as we said, if your super is just sitting there, it doesn't count. So regardless of what payment, you may have had to stop work earlier than you needed to and go for job seeker payment. If the super stays in accumulation and you're under age pension age, we don't look at it. When you turn age pension age, or when you move that super into an income stream, it becomes, or really actually anywhere but the super fund, it becomes assessable. Now, nowadays that means it just becomes a deemed financial asset with every other deemed financial asset that you own. So a deemed financial asset are things like super when you're over age pension age, account-based pensions, the newer account-based pensions, bank accounts, shares, managed investments, loans that you make to another person. And what we do with those is that we don't actually pay any attention to the income that those products are actually generating. So we don't care about the drawdown level that you might be taking from your account-based pension, because we have the deemed interest rate that we say that those products are generating for you, the income that we declare or deem that those investments are generating, regardless of the income that you're actually getting. If you're getting less, you're getting more, it makes no difference. So the deeming rates are 0.25% to a limit or a threshold, and then they go to 2.25% for any money that you hold over those thresholds. And they're different for the thresholds are different for a single person or a member of a couple. Again, go to the website and you can find out what they are. But what it means is that the majority of the money that you may have is only, as far as we're concerned, generating an income of 2.25%, regardless of whether it's a term deposit at 4% or the equivalent of a 7% dividend from your shares, or you're taking 9% drawdown from your account-based pension. All of that is not what we're looking at. It's that 0.25% and the 2.25% from that income. So super, account-based pensions, bank accounts, they're all treated exactly the same, which from my perspective is actually a real freeing thing, because it takes my pension out of my decision framework as to why I should choose to invest in the different ways that I should choose to invest. I'm no longer trying to invest in a particular product to get more pension, because if I treat that product the same as every other product, it won't make any difference to the rate of pension. And now I can focus on what's good about an account-based pension, what it can offer me, rather than what it can offer my pension. And I think from a long-term investment perspective, that's a really good place to be.
That's a really good point. I haven't heard it explained like that last bit there. So, as you said, I think it's a lot easier, so any listeners out there, my gosh, I've got to check what does my bank account earn, what dividend did I get, I'm drawing $50,000 a year out of my account-based pension. None of that matters. It's the deeming that applies there. So that's, again, from a logistical point of view and a headache point of view, that makes the age pension a lot easier.
Yeah, and you're going to be funny when you're filling in the application form and you're noticing we're not asking these questions. You say, why aren't you asking these questions? And the answer is because we actually don't need to know, because we've got those deeming rates that take care of it for us.
Because that's a common thing we get where people are worried, oh, hang on, I'm going to draw extra out of my account-based pension. Centrelink aren't looking at how much you're drawing out of that pension. They just want to know the balance, and then they apply the deeming to that regardless of how much you're drawing for an account-based pension. So I want to hit with a couple of quick fire ones. So I've got my super, I'm retired, I'm getting some age pension. What happens if I make a lump sum withdrawal from my super? Do I have to let you guys know? How does that impact things?
Yeah, so that's what we would call a notifiable event, and they're the sorts of things you have to tell us within 14 days. You never have to tell us if the money goes down. It's not a requirement. You always have to tell us if the money goes. But obviously, from a can I get more pension perspective, it's a good idea to let us know if the money goes down, but you certainly need to tell us if things grow. And when you're looking at total assets growing over $2,000, you've got to tell us within 14 days. Taking a lump sum out of the superannuation fund and putting it anywhere is a change. We need to know where it goes. If you spend it on a credit card or something like that, then those assets have disappeared. Your pension rate may well go up. If you move it into a bank account, they were both financial assets, your rate of payment shouldn't change, but we need to know anyway. So even if it's not going to cause a change in your rate, Services Australia does need to be told when these things happen.
Now, you may be surprised to hear, actually, I don't reckon you would be in the line of work you're in, but we do hear where I've retired, I've got full access to my super, but I've got too much. I can't, my assets and income, I can't get the age pension. You know what? I'm going to go to Vegas. I'm going to bet all my super on black, blow the lot, trip of a lifetime. If I did that, can I again still go and apply for the age pension?
The next day. Wow. Because you're spending the money on yourself. So there's absolutely no rules about people spending the money on themselves. Not that I would actually recommend this as a long-term financial strategy. The pension's really not that important. But from our perspective, as long as you're spending the money on yourself, go on holidays, and just enjoying your retirement, then that's absolutely perfectly fine, and there wouldn't be any problem with that. Spending the money on other people, that's where things get a little bit more complicated, but spending it on yourself is fine. Yeah, right. Yeah, that's the trick right there. So I guess in your travels and the job that you do, and I know that you travel all around the countryside, talking to people, I imagine you would come across
I'll call it misconceptions, a lot of misunderstandings. So just interested, is there, say 2 or 3 top misconceptions that you tend to come across, in your day-to-day?
The biggest one we actually sort of hinted on 2 already. The first one is that I can't apply for a pension because I'm earning the income. With the work bonus that allows you to earn $300 a fortnight in wages before your pension's affected, and the fact that everybody now starts with a $4,000 balance, which means the first $4,000 worth of wages I earn has no effect on my pension at all, you can actually earn quite a bit before the pension's affected. So I can earn a lot and still get a pension. The second one is this thought that I don't need to tell Services Australia because surely they know. It's the premise that I can sort of hit Alt-Tab on my computer and I can bring up your Westpac bank accounts and all that sort of stuff. I can't. Services Australia cannot do that. If you don't tell us, we won't know. And if you've had an increase in assets and you don't tell us about it, then you've got the possibility of actually being paid money you shouldn't have received, and we're going to ask for that money back. So not telling Services Australia of change of circumstances is a big one. The third one is that if I'm not getting a pension, therefore there's nothing on offer for me. And that's not actually necessarily true as well, because there is a thing called the Commonwealth Seniors Health Card. Now, the Commonwealth Seniors Health Card, unlike the pension, it's not assets tested. Its income test is much simpler than the assets test. It's based on a combination of what we call adjusted taxable income plus deemed interest from any account-based pensions you might have. It's higher than the pension income test. From the federal government's perspective, that's going to give you the same reduced prescriptions and potential access to bulk billing that you might be able to get with a pension or concession card. But each state gives different concession cards different powers and different benefits. So what I'd recommend is if you are looking at something like a Commonwealth Seniors Health Card, check your state's website on concessional benefits, because it could be more. Depending on what you have, it could be quite a lot of other benefits that a Commonwealth Seniors Health Card could give you that, it's not the same as a pension or concession card, but certainly better than not having it. So certainly look at, can I claim that concession card instead of a pension?
Beautiful. Going to move, you did touch on this topic, but I just think it's a very important one to just, I guess, put a bit of focus on, is the age pension and people's homes.
Yep.
This is a very hot topic out there. I might be in a $500,000 house, or I might be in a $2 million beachside property. Can you talk to us around how the home and your age pension, what's the relationship there?
Sure. So the first thing is that when we're looking at the rate of pension or the income and asset limits, one of the criteria is, are you a homeowner or a non-homeowner? So a non-homeowner, which might be a person who's renting, is actually allowed to own more than a homeowner, because we're assuming that they haven't been putting all the money into the family home. So that's the first thing. The second thing is, if you are a homeowner, in most cases the family home does not count as an asset when we're looking at those thresholds, the 1 million or so for a member of a couple, the 600,000 for a single person. So we're not counting the home in that. The only time that really changes is if you're actively trying to use some of the home to generate an income, like you've rented out your garage for storage, or you're operating an office out of the spare bedroom, or you're setting up a self-contained unit for renting it out, and you're actually using the family home to generate an income. But if you're not doing any of that, then the entire property and the surrounding 2 hectares does not count for your eligibility for a payment from us. So yeah, that doesn't matter how much it's worth.
Okay, and the big thing there is to realise, obviously, I might have the multi-million-dollar home and getting some age pension, but obviously I can't just sell the garage to generate some income to fund my lifestyle. So something to remember there. What if I go the other way though? Like, so I'll pick on myself as an example. Wife and I got 2 young boys. We've got the bigger house. We've got a bit of a yard for the boys to kick around in. When the boys grow up and leave, we're not going to want something that big to look after. We downsize. So if we're getting the age pension and then we downsize, so we sell our house and buy something cheaper, I imagine there's implications there for the age pension. If you could just speak to that for us, please, Justin.
Yeah, so there's a couple. There's the stage in between, and then there's what happens afterwards. So I've sold my home. The rules from Services Australia is that the money that you receive from the sale of your home that you plan on using to purchase or build your new property does not count as an asset for 2 years while you're in that stage of either looking for somewhere or building somewhere. And that can be extended actually out to 3 years if an event occurs that delays the whole process, like a hurricane comes through and you you knock down and you have to rebuild. Yep. So we don't count it for an asset for up to 2 years. Any money on top of that, so if we use the example, I sold for $1 million and expected to spend $700,000 to purchase a new place, that $700,000 will not count as an asset, but the $300,000 that I expected to keep in my bank account, that does actually count straight away. That will be an asset straight away. The other nice thing about that 2-year rule is that while we don't count the asset, but we also only deem it at the lower interest rate, which at the moment is only 0.25%. So no assessable asset for that $700,000 in the example, and minimal deemed interest coming from it. So it's entirely possible that I've got this $700,000, $1 million sitting in the bank with actually not much of a change to my pension at all.
I'm getting some good takeaways out of this myself. Now, this is probably a bit of a similar situation. You know, we know that we've got an aging population. So if I've got, elderly parents, they pass away, I get an inheritance. Obviously, there's an impact there as well.
Yeah, so an inheritance just basically means there's a new asset, realistically. The important part about this is that it's really only accessible from the date that it is actually distributed, which can take quite a while depending on the reasons for the estate might be contested or whatever it might be, or it might be a hard asset to be realised before it can be distributed. But once it's distributed, it's that same let us know within 14 days. And if it's, for example, there's $200,000 now in the bank account I didn't have beforehand, well, that's a new asset. And depending on the size of the asset, that will potentially have a big impact on my pension or could remove my pension altogether because I've got new assets I didn't have beforehand. It's also important to say that if that money then has to be spent, for example, I already had a mortgage on my place and the mortgage was $300,000 and the $200,000 has just gone to clear most of that, then there isn't actually anything left in the bank. It's all gone into the family home. Family home is an exempt asset. There would be, in that case, no impact on my pension because the money actually didn't stay there. It all went to cover costs. Same if I had to pay debts or loans or credit card bills, I'm paying off my debts, then that's all money you don't have anymore. That won't count. But any new assets that are going to be staying around, that is going to affect your pension, theoretically is going to affect your pension, and therefore you need to take that sort of thing into account. And then depending on the size, depending on what you're going to do with it. So maybe that you do need professional help in order to manage that. But one of the other options that you have is you can certainly talk to Services Australia's Financial Information Service. Now, this is a free and impartial information-only service, so it's not an advisory service. They're not licensed to give advice, but they can provide the whole implications of the decisions. This is what it's potentially going to be. These are what your options are. This is what you can do with it. It's now, with that information, up to you to decide what's the right thing or the wrong thing to do with that money. So that's, as well as your financial professionals, that's absolutely an information service that's out there for anybody. You don't have to be a Centrelink customer to be able to take advantage of the financial information service.
I'm glad you mentioned the financial information service. I've dealt with them quite a lot over the years, and I've just found every single one I've come across to be so helpful, truly there for the general public, for whoever they're dealing with. They're experts in their field, and I've just found them fantastic to deal with. So.
Well, this is where I have to give full disclosure because I was one for 15 years or so.
Okay.
That's where it's all the knowledge is coming from was my time as a FIS officer. But if you do want to have a chat with them very quickly, if you want to speak to one of our financial information service officers, then give us a call on the 132300 phone number. So 132300 and just say the words financial information service when they ask for the reason for your call, and that'll get you through to one of our officers over the phone. They'll take it from there for you.
Beautiful. If you miss saying that, you could be enjoying a phone call for a little while. So make sure you do say that. Now, I want to move on to another hot topic here. So we do a lot of retirement seminars and pre-retirement seminars. Now, I'd almost put it in the 50-50 bag. Half the people that we meet, they want to spend every dollar they've got, and good on them. They've earned it. They do what they like. The other half of the older Australians we meet, I want to leave some money to my kids. I want to help my kids while I'm alive to see them enjoy it. So this brings in the lovely topic. A lot of our listeners might have heard this word called gifting. So example, I might want to help my kids buy a house or help them get ahead in the house. Can you just talk to that?
Yeah, so we're often asked how much am I allowed to give is the nature of the question. And the general answer is you're allowed to give whatever you want. There are no laws in Australia that stop people giving away their assets. There's no tax implications if you do. And Services Australia does not say you can't do that. But what Services Australia says realistically is that you may give away a lot of money, but we're not going to recognise that you don't have it anymore is, I guess, the best way that I can say that. So the rules for gifting from Services Australia is that we will recognise that you no longer have $10,000 in a single financial year, but no more than $30,000 over a 5-year period. Any money that you give away that's over those asset limits, and when I say money, I should also clarify. If I sell a car to my granddaughter and the car's worth 20 grand and I sell it to her for 5, I've sold it for less than its value. I've gifted her $15,000 because I didn't get proper recompense for the asset. So anything like that, or any money that we give that's over those $10,000 limit and $30,000 over 5 years, Services Australia is actually going to pretend that you still own it. And we're going to basically pretend it's money sitting in the bank account and it's earning deemed interest, same as any other money sitting in the bank account. And we're going to keep it on your record for 5 years. So it's going to still potentially affect your eligibility for the next 5 years, or also, importantly, for the 5 years before you apply for a pension. So we're actually going to ask you, have you done any of this before within the last 5 years for applying for the pension? So if you did it 3 years ago, it's still going to affect you for the next 2 years. So we're looking at a 5-year window before we don't count gifting any longer. After the 5 years have passed, we won't count the assets. We'll recognise you don't have it anymore and it won't affect your eligibility any longer.
That's a really important call out there, because we do meet people who, you know, I'm going to give, you know, Johnny and Mary some money and then I'm going to, you know, go down to the Centrelink office and apply for the age pension. So that gifting in that case would be counted, as you said, looking at the previous 5 years.
The way I always describe it is, again, it's your money and you're allowed to do with your money as you wish. And if there's a need and you've got the assets, then absolutely do what you feel is the right thing to do. Just don't do it with the expectation that there's going to be dramatic changes in the rate of pension that you're going to be getting. So as long as you understand that, then absolutely do what you feel is the right thing to do. In those sort of circumstances, the effect of the pension is a side effect of actually trying to take care of the kids or the grandkids or whatever way. And that's, again, perfectly fine. But gifting to try and get more pension is where things get a little bit messy. Because if I give away $10,000 in a single financial year, my pension rate will go up by $3 a fortnight, $30 a fortnight, I should say, if I'm assets tested. Now, that's the equivalent of $780 a year. It takes somewhere in the vicinity of 15 years for that $780 to replace the $10,000 I just gave away in the first place. So, yes, I'll get more pension, but I was better off with the $10,000 in my pocket and just getting less pension at the same time. So it's absolutely there. Yes, it might improve your rate of pension, but that's one of the reasons why I say gifting for improving your pension doesn't necessarily work. Gifting because there's a need, absolutely. It's your money. Do what you need to do.
Now, what if I don't gift that money? What if I actually loan? So I loan the kids the money and the idea is that they pay me back.
So with a loan, we're going to actually not have any of those discount amounts. There's no $10,000 over or $30,000 over a 5-year period or anything like that. The whole amount is a deemed financial asset and the whole amount stays on your record until the loan is repaid, whether that's gradually or at all. And if the loan is never repaid, then theoretically it will stay on your record for the rest of your life. Now, it may well be that after a period of time, say 10 years, you recognise that money is never coming back and you forgive the loan. Then it becomes a gift. And then the gifting rules take into account. So then we're going to take off the $10,000 but keep the balance for the next 5 years from that point onwards. So gifting means that the asset will disappear after 5 years. Loans means that the asset stays until the loan has been repaid.
Beautiful. Now, we're almost coming to a close. So I want to get down to some real black and white, real practical questions here. So a very common one, and the answer might surprise some of our listeners, but when should I actually apply for the age pension?
Absolutely. So you're allowed to lodge an application for the age pension up to 13 weeks before you become eligible. Now, that could be 13 weeks before you turn 67, or if you're already over 67, 13 weeks before a change in your circumstances, like you're stopping work. So if you know that that's going to happen, then you're allowed to apply for 13 weeks. If it's a stopping work, you just provide evidence from your employer that you're going to be stopping at this date, and you can lodge the application then.
Beautiful. So I do not have to wait until I hit 67 before I go and apply.
No, we encourage you to go early because then a lot of the processing is done in the background, so that hopefully as soon as you turn age pension age, the pension payments start because we've done all the work for you before it actually occurs.
Because if I hit 67 and then I apply?
You'll still be granted from the same date, assuming you applied pretty much on your 67th birthday, but it'll be backdated because we'll then start the processing, and that could take a while, and then we backdate the payment. So you still get everything. It's just delayed when that's going to happen.
Okay. Now, again, keeping it basic, how do I apply? Is there documents I need? What's the real,
Best way to apply is online. That's MyGov linked to your Centrelink record. If you haven't done any of that beforehand, then again, Services Australia's webpage, which is servicesaustralia.gov.au, click on that panel that I was talking about for ageing, tells you how to do that. You don't have to go down that path. You can either download the application if you want to hand fill it in, or you can go into your local office. Yes, you are going to need documentation. We're going to need proof of identity. We're going to need proof of residency. We're going to need details of your financial assets, details of your wages. So there will be a lot of paperwork. The more complex your financial circumstances, the more paperwork we're going to need. I really encourage everybody to get as much as you can right at the word go to lodge it all together as one complete package. Will make the processing that much faster, meaning the pension comes to you that much easier.
Let's ask that then. So how long, and this might be, how long's a piece of string?
Well, it really can depend. The more simple your financial circumstances, then obviously the easier that processing will be. The more complex your financial arrangements, where you might be involving family trusts or company arrangements, that sort of thing, then obviously it will take that much longer to process. But I really do recommend, again, that idea of having as much of that documentation up front as you possibly can to make it easier for the whole processing system to work.
Now, just in closing, where can people go for more help? We've covered a lot of ground today. I know that there's some really good resources out there for our listeners. So where would you suggest they go?
Oh, big fan of the webpage, servicesaustralia.gov.au. So not only have you got that panel on ageing, you can also search webinars, and you can find a whole range of financial information service webinars about whole sorts of different financial products, including superannuation, pension eligibility, going into aged care, all of that.
Well, that's all we have time for today, folks. We've covered a lot of information. So as I said at the start of today's episode, make sure if you think any of this applies to you, go for backup. You go and see a financial advisor. They can tell you exactly what applies for your own unique situation. So look, personally, I want to thank Justin for coming along today. Thank you, mate.
Thank you so much for having me.
Beautiful. So if you enjoyed today's episode and you'd like to hear more from us, easiest way is to subscribe on the platform of your choice. That might be YouTube or Apple Podcast, might be Spotify. The links are in the show notes. And thank you so much for joining us on today's episode of Super Insider.